Hello traders, Gary Wagner here just after 10:30 in Honolulu, 3:30 in New York on Tuesday, 25th day of February 2014, and this is the daily report for gold and silver. Mixed bag in the precious metals markets with silver trading lower, gold trading higher. To gold, as you can see, current print on the screen, 1340 and change, puts it up roughly $4 on the day. That's a spot market. Over here to the left, we have our COMEX gold futures. This is a continuous contract, 1340.70, so they're fairly in sync. Noteworthy or of interest is when we look at the 52-week high and the 52-week lows. The high over the last 52 weeks was 1619. Of course, that's right before the drop, and the low 1179. We've had quite a price swing when we consider how this market has moved over this last year. Silver, current print for silver is 2184 and a half, 2186 and a half. Currently putting it off about 11 cents on the day, 2160 on the low, 2210 on the high, and here is the continuous contract on the left-hand side for silver. Traders, we are looking at a 240-minute chart. And in that chart, standard candlestick format, let's go ahead and blow that up a little bit. We can see the kind of price ascent that has really been the characteristics of gold lately. It kind of consolidates, it forms a base here at 1260, spikes up, hits some support just below 1300, which is 1294 right in here. And you can see again, it begins to trade a little bit sideways for a while. In other words, it's consolidating, forming a base. We get that spurt. Then we get, this is where I initially pegged our resistance at, which was 1329, 1340. We can see that it did hit that particular point pretty eloquently and then retrace. This retracement was exactly a 23% retracement. Has basically steamrolled its way back up, and you can see aside from a couple of areas, a couple of bars, these red bars, it's predominantly green. Market has been up, there's no doubt about that. And what you'll see is that when we convert this to the Japanese average, it's going to give us a different set of information because of the parameters of drawing that chart. Let's go ahead and convert that. And you can see the difference when we go ahead and convert that. The red candle that we just saw is green, and that's because it's comparing it to the prior midpoint rather than having that true open or close. We can still see fairly eloquently the resistance up here at 1329. We can also see that at that point, it really found this particular price point a supportive price point. In other words, it was resistance here, it was a ceiling, but here it appears as though it is becoming a floor. I am seriously debating right now raising our stops, and those stops need to be raised. If you want to go ahead and raise them, would be raised to be below 1329. You'd want to cover these lows that are in here. We'd also want to look at the lows over the last few days, and for that, we'd need to pull up a daily chart. Now, when we pull up a daily chart, a couple things become evident. The first thing is that we're getting a small body candle. In other words, the difference between the open and the close. It's green, so it's above the open. At the same time, it's almost doji-esque or doji-like in that it's a very, very small bodied candle, unless it really took off towards the close. We do have a little bit of trading time left in New York, but not that much. My sense is right now that for any kind of stop to make sense, you almost need to put it below, not today's low, but the prior day's low. And so if we do that, because of the move that we saw, see the low, the prior day low comes in at around 1218. So a more conservative stop would have to be around 1215, 1217. We currently have it at 1207. And that's the reason really I've not moved it yet, is when we look at the bigger picture, what you can see is yesterday's low still at around 1318. And so that 1329 only covers the lows of today, the low of today being 1330. We're looking at a two-day chart. This two-day chart is 100% fib retracements. There's quite a few of them. And really what I've done on this chart is effectively gone from different bottoms to the top, different peaks to the top, to come up with all of these different fib levels. Now, what I typically look for in a fib level is, as you are well aware of, is harmonics. And in terms of harmonics, 1300, and we talked about this, was pretty strong, and we felt that that was a harmonics that would be a good level of support. We also talked about this long-standing resistance line, and we've broken above that. Our next real target or level has got to be the previous top. You can see that lining up right here, and that top itself, when we look at where this particular top comes in, it's around 1365 to 1373, and that's this particular top right in here. That's going to be our next real level of resistance if we have not already hit some sort of resistance at this point. This last rally has been technical in nature, and so when it is technical in nature and there's not real news fueling the market, we want to be careful in terms of where the technicians are going to come in and find some resistance. Now, this particular top here is a top that I mentioned, right at around 1360 up to about 1373. That's going to be, if the market continues to move higher, I believe to be the next real level of resistance where we might see any kind of a pullback. Where I expected a pullback was 29. We didn't get it, and I'm glad. Because we're still maintaining our long position. And this is that the pullback that we got was a very, very shallow, very minor kind of pullback, just 23%. And it was a 23% of this move here, meaning not even from the bottom of this particular rally. So I found it kind of interesting that it really clipped and moved past there. But these are the kind of surprises that I like to get. Obviously, if we're long, we want to be able to maximize any kind of profits out of this trade, but at the same time have sensitivity to be able to ride it if it wants to continue to move higher. And so with that in mind, those are my suggestions to you. On record, we're continuing to hold our stop where it is, which is just below 1307. But as I said, I would be looking to move it up. And the point that I'm going to look to move it up has got to be below the 1329 area. Now, traders, we're looking at a daily cash Standard & Poor's chart, the equities markets. And we've had a basic divergence today between equities and the precious metals. Well, specifically gold. Gold and the equities have been moving in tandem over this last week. We are seeing a little bit of weakness in the market in the equities markets today. And interestingly enough, these are just channel lines that I drew in the market, in which as we saw this market rise, I was simply pegging some of the highs and some of the lows and carrying them up. And we are now at this first channel band, and we've hit a high right about there. This, of course, is Japanese average chart. You'll see a key difference when we convert this, and we convert it by removing this as a study. And when you do that, you see a different picture. And the picture that you're seeing is this star, which is gapped in an evening position in the equities markets, and it is right at about the channel that we've drawn in. What does it mean? Well, we'll take a look over time and see if this was a point in which we saw the market trade lower because of that, hitting this resistance in this particular up channel band. Which takes us to our basic daily chart that has our intermediate count in Elliott wave, as well as our long-standing resistance line. We've absolutely crossed that. My sense right now is that we've seen A. A should take us probably to the top of this channel. If we haven't begun to see any kind of top action here, we could see it rise as much as maybe 60 to 65, maybe even as high as 73. I believe at that point we'll go into some sort of a B counter wave. This is a counter trend, so the counter wave is going to be in the direction of this bear run that we've seen down, and then we should see upon the conclusion of that B wave some sort of an A, and that A should push us up, I believe, to about 1435. In other words, match this particular top right in here. That's my current take on the market. So what about silver? Well, we've seen a dramatic rise really off of the bottom in silver. That rise really caught a lot of people off guard because we had been trading in this really narrow muck range. This is a weekly chart, and you can see October, November, trading within this defined range that we had talked about. Market broke out solidly, broke out, substantially, is trading above there, but now is getting really, really close to that resistance area that we have identified, just above $22 per ounce. If we see some sort of weakness in the equities markets, it could easily spill over into silver, being such a highly used industrial metal. We've been sidelined on silver. We've put our capital in gold, and that has been paying us off in spades. It's been a rewarding trade in there, and I'm comfortable with it. I wouldn't be surprised to see a little bit of weakness, though, in silver up in these areas. If, in fact, we see the equities markets come under pressure, we could see silver kind of falter. And if gold begins to falter, of course, we'll see silver running in tandem with that. But for the meantime, I am satisfied with our position in gold. We'll look to see how we can incorporate silver. My sense is that if we get that A and get that B wave in gold that's easily identified, we see that B wave in silver. Once we have some concrete evidence that we're now in the beginning, that pivotal point, and we're going back into an up C wave, then we'll probably go long both gold and silver. We'll have pulled profits on our gold. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.